Alright, so in this video, I will teach you a brand new ICT's Sun's trading strategy. Yes, you heard that right. I will teach you ICT's Sun trading strategy in this video. He revealed his model, his son's model, in the live Twitter space a couple of days ago. And this model is insanely powerful. That's how his son passed the challenge, right? And he made his first payout. If you are active on Twitter, you might know about this. But I posted this strategy on my Twitter and it got a lot of engagement, 57k views and a lot of likes and all. People saying that I'm backtesting it, it's a monster. And I've backtested it as well, and it is a monster trading strategy. I have never seen something like this before. This is like insane, all right? So let's start with the video. I will give you a lot of examples at the end, but we first need to understand the whole strategy. And I'm going to explain each and everything in this. So the number one rule here is that we first of all have to identify our higher time frame draw on liquidity, right? So our higher time frame is going to be 1 hour time frame, as I have annotated right here, right? So this portion right here is you want to see where are we coming from? What is our draw on liquidity? Where is price likely to go on the higher time frame, which is 1 hour time frame? And I'm going to teach you that how you can identify where the market is going to go later in the video. But let's talk about the basic rules of this strategy first, right? So you want to have a draw on liquidity on your high time frame, which is going to be 1 hour time frame, right? So let's say that the order flow is bearish, right? You can anticipate that this low is going to be taken out because price is going down, right? It has a business down there. That's why it's going down. So you have to look, where is the liquidity level, right? This right here, this low right here is our draw on liquidity. But I'm going to later, as I said before, I'm going to teach you how to like simplify this by using external and internal liquidity method. So keep on watching, right? So if once you have your draw on liquidity marked out, which is your 1 hour draw on liquidity, all you have to look for is basically you have to like look at what is the order flow, right? So I have annotated here that we first of all, where did we come from? We purged this 1 hour liquidity and then we had a 5-minute market structure shift. So let's assume that this was external liquidity. And if you don't know what I'm talking about external and internal liquidity. That is how you find your intraday bias or daily bias or weekly bias. I'm going to link the video on the top right now. You can click on that card and it will take you to that video, which is going to teach you about external and internal liquidity. If you have no knowledge about that, go and watch that video first. I will also link that video in the video description. Go and watch that and then come back to this video so you have better understanding of external and internal liquidity. So let's assume that this was 1 hour external liquidity. Price takes out 1 hour external liquidity. Now to confirm our bias, intraday bias, right? We have to look for a 5-minute market structure shift. So in this scenario, so usually for daily bias, what we would do is we would be on, a daily time frame. Then after a purge on the daily, right, external liquidity, we would look for a market structure shift on the 1 hour time frame, and that would confirm our daily bias. For this intraday bias, we're gonna be starting with on the 1 hour time frame. So we will start on the 1 hour time frame. That is gonna be our higher time frame, right? So we wait for price to either take out external liquidity, right? Once price takes out external liquidity, we will drop down to 5-minute time frame, right? And we will look for a market structure shift. Once you will get the market structure shift, that will confirm your intraday bias. And let's assume that this low here is a fair value gap. This line drawn here is the fair value gap, which is also known as internal liquidity. Again, go watch that video and that is gonna clarify everything. So let's assume that this 1 hour line that I've drawn is a fair value gap, and this here is the high. Price takes out this high on the 1 hour time frame. You can then look for a 5-minute market structure shift. That will then confirm your bearish order flow, and then we can proceed further with the strategy. However, if this has already happened and you see that price is going down, right? Price is going down on the 1 hour time frame. It's going down, right? You can then mark out the closest low here, right? Then you can anticipate that price is going to go in that direction. That is like the second way. But I highly suggest that you first stick to this rule. You have to look for a fresh order flow. That's what I do. So once you have a shift in the market structure, right, that will confirm your bearish order flow. Now, here's when the strategy gets interesting, all right? Once you get a market structure shift, you have to wait for price to create a 5-minute high, right? So in this example, you can see price created a high over here, right? Then price created this high over here as well. Now, once price takes out this high or this high, you drop down to 30-second time frame. Yes, you heard me right. 30-second time frame, 30. Now, here's one downside about this strategy. You have to pay for a premium trading view package to access the 30-second fair value gap. But trust me, it is totally worth it, okay? You will get that money back in a week or two. Trust me. So it is worth the investment. Trust me, guys. So once you wait for market structure shift, then wait for price to create some form of liquidity on the 5-minute time frame, right? A swing high is the best way to go. Once price creates a swing high on the 5-minute time frame after market structure shift, after we know that the order flow has switched into a bearish order flow because we confirmed our bias by using the external and internal liquidity method, go watch that video right now if you don't have any knowledge about that. Now, as soon as the price takes out the 5-minute swing high, which is right here, you drop down to 30-second time frame, and then you look for price to drop lower and create a fair value gap. You don't have to look for market structure shift. You only have to look for a fair value gap that forms on the 30-second time frame, guys. This is as easy as it can get, okay? I am giving you a full rule-based strategy. Of course, ICT, taught this on his live Twitter space, but I back tested and tweaked this strategy for like days, okay? And I know what I'm talking about. It works. Whatever I'm teaching right now, this is like the correct version of what ICT taught, right? You can watch other people's videos on this, but I guarantee you this is the method that you only need to watch. So where were we? As soon as price takes out on the 5-minute time frame the swing high, right? As soon as it goes above it, you just drop down to 30-second time frame. Look for price to create a 30-second fair value gap. No market structure shift is needed. And then you simply take your entry off that fair value gap. Now, what are the stop loss and take profit rules? ICT said that his son can risk 12 handle stop loss. So if you don't know what are handles, we're talking about assets. We're talking about S&P 500 and NAS 100 or US 30, right? So in terms of S&P 500, he would take his entry here. He would put his stop loss at 12 handle stop loss, right? And he would target 10 handles. So that is basically a negative RR, but ICT said that it works. It has above 80% strike rate. So even if you have a negative RR with this strategy, you will be still extremely profitable. However, after backtesting for a lot of days and tweaking the strategy, what I've found is that you can go for 10 handle stop loss and 10 handle take profit level. That would give you 1-to-1 risk to reward ratio. That is a perfect way to go. All right. So guys, very simple. And price, he said also that price doesn't have to go towards that draw on liquidity. We just need to know where the market is likely to go. The market is never going to go to your draw on liquidity 100% of the time. We're just creating an idea that where the market wants to go. All right. So a very simple strategy, guys. First of all, we identify our intraday bias, and that is when we go from 1 hour time frame to 5-minute time frame. On the 1 hour time frame, we look for a purge on the external liquidity. Then you find a fair value gap that is unmitigated and it is in the discount. So this leg over here, you use your fib from bottom to top and use the fair value gap that is in the discount. That is going to be your higher time frame draw on liquidity. Once you have the higher time frame draw on liquidity marked out, and once you have the 5-minute market structure shift, that would confirm now that we are going to go towards that higher time frame draw on liquidity, which is going to be the 1 hour fair value gap in the discount. Right? Then you simply wait for price to create a 5-minute swing high, right? This price created right here and also right here, right? Now, the next step is that you have to wait for price to take out that swing high on the 5-minute time frame. As soon as price takes out the swing high, drop down to 30-second, look for a fair value gap that forms, right? And then you take your entry, go for 10 handle take profit, 10 handle stop loss. Very easy, guys. Let me give you guys a couple of examples and then I will end the video. All right, guys, so here is example number 1. Now, before I move to the example, I just want to clear something that external to internal liquidity method to find your intraday bias is not the only method, okay? There are tons of ways to find your intraday bias. So for example, there's a way where you can only look for purge of a high and then you can wait for price to take out the low. So that would be your buy side liquidity purge. Once you have that, you look for 5-minute market structure shift, right? And once you have a 5-minute market structure shift, you can anticipate that price is going to not take out the sell side liquidity, which is here. The external to internal liquidity method is the safest way, right? You have a very high strike rate when you are trying to find the daily bias or intraday bias that way. But it doesn't mean that that is the only way. So in this example, I'm going to show you this method. So on the 1 hour time frame, we're going to take out the buy side liquidity. So over here, you can see we have taken out the buy side liquidity, right? Now, instead of targeting this fair value gap, right, that is way up in the premium, all right? So we will not get enough room to for the expansion to the downside for us to take a trade, right? Because that would be already filled. However, what we can do is we can anticipate that this is going to be our draw on liquidity. Now, it is absolutely not necessary to find like the right draw on liquidity. You just need to have the idea. If price has taken out buy side, where is the next target? Okay, where is price likely to go from here? It has taken out buy side liquidity here. Where is it going to go? The clear target is right here, right? And one more thing that you can add into this is look at the auto flow. Right? Where are we going? So if we are bearish, look for buy side liquidity purge and take short positions. Anyways, in this example, we have taken out buy side liquidity. This is our sell side liquidity target. So let me remove this real quick. Now, once you have the liquidity sweep, that is not confirmed that we're going to go towards here. So we have to go to the 5-minute time frame and we have to actually look for a market structure shift now. So we have taken out the 1 hour buy side liquidity. Let's see if we get a market structure shift. We do get a market structure shift. So that is a PM session. So we're trading micro E-mini S&P, right? It works with Forex as well, right? But for the sake of this video, I'm gonna stick to the indices and futures for this video, right? So we have a market structure shift. Now, once we have that, all we are looking for is a purge on the buy side liquidity, right? Now, once we had the market structure shift, our bias is not confirmed, intraday bias, that we're gonna go ahead and take out this level. All right. So all I'm looking for is a purge on the level, and that's when price hits that. As soon as price goes above it, I will drop down to 30 seconds time frame. Now here onwards, I'm only looking for a fair value gap formation. So price gives us no fair value gap until here. That is when we get the fair value gap. So what I will do is I will put my short position just a little above the the opening fair value gap, because that will then guarantee that price has actually filled the fair value gap. So my stop loss would be 10 handles. As you can see, this shows you the handles. So it's at 4.5. I'm going to go with 10 handle stop loss. and 10 handle take profit level. That is 1-to-1. So moving it like that, let's see how this plays out. So we got a tap into our fair value gap, and let's see how this plays out. Remember, we took this during the PM session, so make sure that you're taking your trades during kill zone timings. And that is right there, your take profit level hit. Let's move on to the next example. All right, guys, so here is example number 2. Now, this is going to be the external to internal liquidity method, right? So this one is one of my favorites. So you can see we have taken out external liquidity, which is right here. Remember, price takes out, a high or a low, and then it rebalances itself into the fair value gap, right? When a price has gone expensive, it has to come into the fair value. It has to be a fair value, right? So price is always going to come towards the fair value gap after taking out external liquidity. So this is the fair value gap. Now, once you've taken out the external in 1 hour, let's go to 5-minute time frame, and we look for a shift in the market structure. Remember, we can account for the wicks as well in this, because you can see displacement is pretty huge. Now, we're waiting for a high to be formed, right? So as you can see that we have this high formation here, right? We have a candle to the left, smaller, and boom and boom. Let's see if we can get an entry from here. This is our draw on liquidity. So let's go to 30 seconds time frame. We look for a fair value gap. No fair value gap at the moment. We look for a fair value gap, and that is when we get the fair value gap, guys. But sadly, as you can see, okay, we did actually get the entry right there. That is your fair value gap entry. Now, I would always look for an entry of the extreme fair value gap just to reduce my, stop loss, if that makes sense. Because if I take my entry here, my stop loss and my target take profit level is going to be far down there, which reduces the probabilities of a trade playing out, right? So as usual, my stop is going to be 10 pip. ICT rule, his son's rule is 12 handles, but I go for 10. And simple 1-to-1, guys. So we are in the trade now, and let's see how this plays out. So it goes for some time. Notice one thing, this trade was taken during the kill zone timings at 10 New York time, AM session. And right there, we have our take profit level hit. Now let's remove this. Let's go to 5-minute once again. And you can see that we had created this high over here as well. So you can actually pyramid in. You can see we have a purge here. Let's drop down to, since we have our high time frame drawn liquidity still intact, we would have gone to 30 seconds time frame, and we would have looked for a fair value gap. Here there was no fair value gap, but then price created this fair value gap here. You can see it filled to the tick. Now I would have missed this trade, but as you can see, the algorithm is real. It just filled it to the tick right there. Let me move this here. You can see it touched the fair value gap. Stop as usual. We'll go 10 pip stop loss, and actually I would take my trade because our drawn liquidity is closed now. I would actually put myself, increase my a little bit of risk, right? Just so I can get 1-to-1. All right. If I have my stop loss at 10, I'm risking the trade. Okay, because this is our actual draw on liquidity on the higher time frame. And once it's filled, price can do whatever it wants to do. So that is why I would put my TP here and just decrease my stop loss in this specific scenario, guys. Not always, okay? So you can see that the take profit level was hit, guys. Let me give you guys one more example, then I'll end the video. All right, guys, so here is the last example. So in this scenario on the 1 hour time frame, this is our sell side liquidity, and this is going to be our buy side liquidity. Remember, you don't have to be accurate 100%. Like, you don't have to be 100% accurate on this. You just have to need to have the idea. You just have to need the idea where the market is likely to go. That's all it needs. Okay. So we have taken out this sell side liquidity. Before moving to the example, let's talk about our course plus private Discord server. So initially this was priced at $200, but you can get it for $97 at the moment. It is 49% off till the next month. Right? Let me quickly tell you, you get a private Discord server where I share my own trades. You get monthly course update with new videos, Q&A and more. And then you get the SMC basics, right? If you're just a beginner, then you got the basic trading strategies. These strategies work without daily bias. Then you got the ICT essentials. That is what you need to move to the advanced trading strategies. And after that, we have the market maker models. We have the daily bias, weekly bias, monthly bias. Right, we got the holy grail, we got the second distribution entries, we got silver bullet with bias and all that sweet stuff. This is some proof here. I passed a couple of challenges, but I don't want to make my website look bad. That's why I only have one here. You can see my Instagram, and then you will find proof that I'm actually a funded trader, multiple accounts holder, and that's all. And then we got some students that passed the challenge and whatnot. Let's move on to the example. So we took out the sell side here on the 1 hour. So let's go to the 5 minute to confirm that we're gonna likely head towards that direction. Over here, I can see this high. So if when that is broken, I'm gonna consider a switch in the auto flow. That's right here is when we break the structure. Remember, Wix account you can consider them as a market structure shift for this specific strategy. So now we simply look for what? We look for a purge on a sell side liquidity, which is right here on the 5 minute time frame. And now we're gonna go down to 30 seconds time frame. Now we are looking for a formation of a fair value gap. That is not a fair value gap at the moment. And that's when you get the fair value gap, guys. Now this is going to be your entry level. You will go long just there. Stop as usual. We'll go 10 handles, and your take profit will also be 10 handles 1-to-1. Price dips into that fair value gap, fills it completely, and after a couple of minutes, playing this through, the take profit level was hit. And you can see price goes up towards that higher time frame draw on liquidity. You can see that the entry was during kill zone timings, 9:55, guys. So that's pretty much it about this model, guys. Go and back test this. It works absolutely brilliantly. Yeah, I'm actually new to this strategy as well. It's not that I'm the master with this strategy, but this method works, guys. This is what ICT said in his live space, right? And this is what I tweaked and back tested, and this is what it comes to. This is the model. One last bonus tip that I can give you is, instead of looking at 1 hour time frame as your higher time frame, you can look at 15 minutes time frame as your higher time frame, right? And then you can draw out your 15 minutes draw on liquidity. To confirm that price is going to go towards that draw on liquidity, you have to look for a market structure shift on 1 minute time frame instead of 5 minute time frame, like we would do with 1 hour time frame. Once you have 1 minute market structure shift, you simply look for a 1 minute swing high or low to form, a purge of that swing high low, and then you go down to 15 seconds time frame and frame your trade. Anyways, that's it. I'll see you guys in the next one. Goodbye. Wow.